In the summer of
this is the critical juncture. If we
1958,
don't address these
a
rising
young
costs
stockbroker
now,
from
the
Oklahoma
entire
made a
project is
discovery
at
that would
risk.
challenge everything
The
Wall Street
volatility is
believed about
spiking.
finding
We have
winning
to unload these
investments.
assets now.
William O'Neill
But if we
possessed
hold until
no
the bell,
Ivy
we
League
could still
credentials,
recover.
no
The risk is
family
too
connections
high.
to financial dynasties, and no advanced degrees in economics. What he carried instead was something far more dangerous to the establishment.
I need that
An
margin call
unshakable
covered by
conviction
noon.
that the market's
Sell
most
50,000
profitable
shares
secrets
of
weren't
KO
hidden in
right
boardrooms or
now.
whispered among
We have to
institutional
unload the
insiders,
MSFT.
but were displayed openly on every price chart for those who knew how to read them. O'Neill's breakthrough emerged through relentless observation rather than academic theory. While his colleagues at Hayden, Stone, and Company relied on traditional fundamental analysis and research department recommendations, O'Neill spent countless hours studying the visual language created by price and volume movements.
Because someone
He
knows
began to
something
notice
we don't.
something extraordinary
This isn't matching the
that
morning
others
figures.
had
We need to move
completely
fast.
missed.
The paper says hold. Look
The
right
biggest
here.
winning
Why are these
stocks didn't
climbing?
randomly
Because
explode
someone knows
higher.
something we don't.
They displayed specific visual signatures weeks or months before their major advances. Signatures that revealed the quiet accumulation of institutional money long before financial journalists caught wind of any story. The young broker's methodology defied conventional wisdom on multiple fronts. Wall Street's establishment preached that charts were meaningless squiggles, that only earnings reports and balance sheets mattered for serious investors. Yet O'Neill was discovering that these supposedly meaningless patterns contained a form of market intelligence more reliable than any analyst's recommendation. His charts revealed the psychological battlefield, where fear met greed, where weak hands transferred shares to strong ones, and where patient institutional buyers accumulated positions before launching sustained campaigns that could multiply investments several times over. He pulled decades of market history onto his desk and began assembling detailed studies of prior market champions. Home Depot sprinting from its 1,981 initial public offering. Medical innovators exploding from quiet consolidation patterns. Technology leaders breaking out of tight trading ranges with explosive volume. He circled the same visual signatures again and again.
We need to move
Periods
our
of
assets
quiet
before
accumulation
the crash.
followed by decisive breakouts. Volume patterns that revealed institutional interest, relative strength lines that climbed even when individual stock prices remained flat. This painstaking research revealed the central tension that would define his revolutionary CAN-SLIM methodology. Successful investing required both systematic rules and intuitive pattern recognition working in harmony. Logic provided the foundation through fundamental criteria like accelerating earnings growth, institutional sponsorship, and leadership characteristics. Intuition provided the timing through reading the subtle character of breakout patterns, the quality of volume signatures, and the difference between genuine institutional demand and mere speculative enthusiasm. O'Neill's early results validated his synthesis approach. He transformed initial investments into substantial returns by trusting both rigorous data analysis and educated market intuition simultaneously. This integration became his crucial differentiator from purely quantitative traders who ignored market psychology and purely intuitive investors who lacked systematic discipline. He eventually founded Investors Business Daily not to mystify markets with complex theories, but to democratize access to this visual intelligence that revealed institutional behavior patterns. The Oklahoma newspaper boy had cracked Wall Street's logic by recognizing that charts weren't just historical price records. They were psychological maps revealing the footprints of institutional accumulation, the rhythm of market cycles, and the eternal dance between human emotions and mathematical probabilities. His discovery proved that the market's greatest secrets were indeed hiding in plain sight, waiting for someone willing to look beyond conventional wisdom and trust what the patterns themselves were revealing about the underlying battle between fear and greed that drives every significant price movement. O'Neill's journey into reading market psychology began with a radical shift in perspective that transformed abstract price movements into windows revealing the collective mind of institutional money. He discovered that charts weren't merely historical records of past transactions, but dynamic psychological maps that displayed the eternal battle between fear and greed, between weak holders, desperate to escape losses, and sophisticated institutions, patiently accumulating shares before major advances. His breakthrough insight emerged through recognizing that large institutional investors, with their massive buying power and professional discipline, left unmistakable footprints on every chart. These footprints appeared not as random price fluctuations, but as predictable psychological phases that preceded virtually every significant stock advance. When institutions decided to accumulate a position, their sheer size made stealth impossible. Their buying patterns created visual signatures that O'Neill learned to read with the precision of a conductor interpreting an orchestra's subtle dynamics.
Look at this graph.
The cup with handle formation became his most reliable psychological roadmap, typically unfolding over 7 to 23 weeks in a carefully choreographed sequence of emotional phases. The initial decline represented fear-driven capitulation as weak holders abandoned positions during market corrections or company-specific concerns. Creating the left side of the cup, the gradual recovery phase revealed patient institutional buyers stepping in as prices reached attractive levels. Their steady demand forming the rounded bottom that gave the pattern its distinctive shape. This wasn't random price movement, but deliberate accumulation. Institutions absorbing shares from discouraged sellers at increasingly favorable prices. The handle portion provided the final psychological test before breakout, as prices approached previous resistance levels and triggered a predictable response from nervous shareholders. These investors, having endured months of sideways or declining action, rushed to sell at break-even levels, rather than risk another decline. This created a brief pullback that served a crucial psychological function, shaking out the last remaining weak holders while allowing institutions to complete their accumulation at even better prices. Volume patterns during these formations told the complete psychological story with remarkable clarity. Heavy selling volume during the initial decline confirmed genuine fear and capitulation among retail holders, gradually diminishing volume as institutions absorbed shares during the base formation revealed the transfer of ownership from weak hands to strong ones. Most critically, light volume during the handle phase indicated supply exhaustion. Sellers had largely capitulated, leaving institutions holding the majority of available shares and setting the stage for explosive moves higher. O'Neill validated these psychological readings through meticulous study of market champions like Home Depot during its early 1,980 seconds formation, and Amgen throughout its 1,990 seconds advance. Each case demonstrated the same underlying truth. Breakouts, accompanied by 40 to 50% above average volume, signaled authentic institutional demand, with the power to sustain extended advances, while breakouts on weak volume revealed speculative interest that typically failed within days, as institutional support remained absent. The most challenging aspect of mastering this psychological interpretation involved training himself to see beyond the daily noise that captured headlines but revealed nothing about institutional behavior. O'Neill learned to ignore dramatic single-day movements and focus instead on the gradual shifts in volume patterns, the character of price action during pullbacks, and the relative strength lines that often peaked weeks before price breakouts, as institutions quietly accumulated shares ahead of public recognition. This discipline required him to trust the visual evidence of accumulated institutional behavior over prevailing sentiment, transforming him from a mere observer of price movements into an interpreter of the market's deepest psychological currents. O'Neill's recognition that chart psychology alone couldn't sustain consistent success drove him to construct the systematic foundation that would anchor his intuitive insights in measurable reality. Through painstaking analysis of thousands of historical market leaders, he discovered that winning stocks shared identifiable characteristics that appeared months before their major advances. Characteristics that could be codified into a logical framework he would call CAN SLIM. Current quarterly earnings acceleration became his primary filter, demanding 25% or greater growth that signaled genuine business momentum rather than accounting manipulation. This criterion reflected a crucial behavioral insight. Institutions don't accumulate shares in companies experiencing declining fundamentals, regardless of how attractive their chart patterns might appear. Annual earnings consistency provided the second layer, ensuring that quarterly spikes represented sustainable business improvement rather than temporary factors that would disappoint sophisticated investors. New developments within target companies created the narrative fuel that captured institutional imagination and justified sustained accumulation campaigns. Whether through innovative products, expanded market opportunities, or transformational management changes, these catalysts provided the fundamental reasons for institutions to initiate major positions. Supply characteristics,
Look at these
particularly
numbers.
shares
It's
outstanding
dropping
and floating
faster than we
supply,
anticipated.
determined
We have
how
to sell
quickly
before the
institutional
market
demand could
completely
move
collapses.
prices, with tighter structures amplifying the impact of professional buying like dry timber responding to flame. Leadership revealed itself through relative strength rankings between 80 and 99, indicating superior price performance that often preceded major breakouts as institutions accumulated shares ahead of public recognition. Institutional sponsorship quality mattered more than quantity, with O'Neill favoring companies attracting disciplined growth funds whose research capabilities and patient capital deployment provided sustained demand. Market direction confirmation ensured that individual stock strength aligned with broader institutional risk appetite and equity accumulation patterns. This systematic framework created a refined universe where fundamental strength, institutional interest, and structural characteristics
Look at this
converged.
graph. It's
The methodology
unsustainable. We need
transformed
to cut our
O'Neill's
losses
approach into a
immediately.
two-step
Cut our
process.
losses? Are you forgetting
Logic
the long-term
filtered the
forecast
universe
entirely?
to companies whose numbers,
This trend is unsustainable.
novelty,
We have exactly
and
48
structure
hours to
suggested
liquidate
genuine
these assets
potential,
before the entire
while trained
portfolio
intuition
collapses.
judged the character
Gentlemen,
of bases,
This is the
volume
critical
patterns,
juncture. If
and
we don't
breakout
address
quality.
these rising
When the
costs
limited
now,
carved its
the
flat
entire
base in the
project
mid
is at risk.
1,980 seconds, or biotech leaders showed relative strength lines surging ahead of price. The synthesis of systematic screening and chart psychology revealed opportunities where probability tilted decisively towards sustained advances. Execution became the crucible where O'Neill's systematic theories collided with the brutal emotional reality of markets, revealing that knowledge without disciplined action remained worthless against the psychological forces designed to exploit human nature. He discovered that successful trading demanded precise responses to predictable emotional pressures, creating behavioral systems that worked with market psychology rather than against the fundamental human instincts that destroyed most investors. His entry discipline required surgical precision that violated every natural impulse toward patience and bargain hunting. O'Neill learned to buy stocks as they cleared valid pivot points with decisive conviction.
Because someone knows
Typically
something we
within
don't.
0 to 5% of breakout levels on volume, running 40 to 50% above average. This wasn't merely technical precision, but psychological warfare against his own instincts, forcing him to act on strength when every fiber urged him to wait for weakness that rarely materialized. He distinguished sharply between conviction and enthusiasm,
It doesn't matter now.
recognizing that conviction emerged from evidence while enthusiasm bred from emotion, and only evidence-based entries survived the inevitable tests that followed every breakout. The discipline of never chasing positions beyond 5 to 10% above buy points protected him from the seductive trap of emotional buying after momentum had peaked. His research proved that properly breaking stocks rarely offered second chances at better prices, making precise timing essential rather than optional. When positions moved favorably by 2 to 3% with continued constructive volume action, his pyramid approach allowed careful position building from strength rather than hope, ensuring additional capital entered only when probability remained tilted in his favor. Perhaps his most crucial psychological breakthrough involved implementing non-negotiable 7 to 8% stop losses that preserved both capital and mental clarity simultaneously.
We need to move
This
our
rule
assets
forced
before the
automatic
crash.
responses that removed paralyzing decision-making when positions moved against him, creating systematic behavior that protected him from the hope and rationalization that destroyed countless investors who confused temporary paper losses with permanent capital impairment. Small losses became simply the cost of doing business, while the discipline created unshakable confidence, knowing every trade carried defined, acceptable maximum risk. O'Neill maintained a detailed catalog of failure modes that served as psychological tripwires against predictable human errors, buying low-quality laggards in search of bargains, ignoring crucial volume signals that differentiated institutional demand from speculative noise, averaging down on losing positions, and selling winners too early from fear, all represented systematic violations of market reality. When Home Depot broke out properly from its early formations, his rules demanded immediate action despite the discomfort of buying strength, while failed breakouts earned swift exits regardless of hope or attachment to original analysis. This execution framework transformed theoretical knowledge into consistent profits by creating behavioral responses that honored both chart psychology and risk management principles simultaneously. The
Herald is
craft,
already
he
printing the
discovered,
afternoon edition.
wasn't
We have
predicting
to get a
market
statement from
outcomes,
the
but
judge.
enforcing
They can't
systematic
keep this
conditions
quiet
that
much
positioned
longer.
him
The
advantageously
Herald is
when
already
probability
printing the
shifted in
afternoon
his
edition.
favor, turning
have to get a
disciplined
statement from the
execution into the
judge.
bridge between systematic analysis and sustained trading success. O'Neill's recognition that even perfectly selected stocks could be swept away by institutional selling
the news
tides
about the docks?
drove him to develop
Keep your
sophisticated
voice
market
down,
timing
man. This ain't
that read
the
the
place.
collective psychology of professional money with the same precision he brought to individual chart analysis. His breakthrough insight revealed that markets moved in predictable institutional rhythms, with periods of accumulation creating favorable conditions for his methodology and periods of distribution demanding defensive positioning, regardless of individual stock
numbers.
strength.
It's
The
dropping
follow-through day
faster than we
became his primary
anticipated.
instrument for
We have to
detecting when
sell before the
institutions
market
shifted
completely
from
collapses.
defensive caution to aggressive accumulation after market declines. This signal appeared as a major index advance on volume running 40 to 50% above recent averages, occurring 4 to 10 sessions after meaningful market lows, and representing the institutional equivalent of an all-clear signal. The timing window proved crucial psychologically,
Can't get out.
as
We need more
institutions
collateral
required several
immediately
days to
or we're
evaluate
finished.
conditions,
The fog's rolling
assess
in
damage,
fast. We
and
need to move
coordinate
this
renewed
now.
buying
Tell the
campaigns
men
that
to
created
pick up the pace or
unmistakable
they don't
volume
get paid.
signatures preceding sustained market advances. O'Neill discovered that this methodology demanded contrarian courage, forcing him to act when pessimism remained thick and public sentiment urged continued caution. The follow-through day represented institutional conviction overcoming fear, typically
this
manifesting
graph.
as
It's
percentage gains
unsustainable.
near
We need to
2%
cut our
on major
losses
indexes,
immediately. Cut our
accompanied by
losses?
decisive
Are you
volume
forgetting the
expansion
long-term
that
forecast
distinguished
entirely?
genuine
Gentlemen,
accumulation
this
from mere
trend is
short covering
unsustainable.
bounces.
We have exactly
This
48
wasn't
hours to
prediction
liquidate
but
these
permission,
assets before the
providing
entire
systematic
portfolio
confirmation
collapses.
that institutional risk appetite had shifted sufficiently to support the breakout patterns and leadership rotations his individual stock methodology
Look at
required.
these numbers.
Distribution
It's
days
dropping
served as
faster
the
than
mirror
we
image,
anticipated.
revealing
We
when
have to sell
institutions
before the
began
market
systematic
completely
selling
collapses.
through significant index declines on heavy volume that accumulated like storm clouds gathering before market hurricanes. O'Neill learned to count these warning signals meticulously, recognizing that isolated distribution days meant little but clusters of 5 to 7 within several weeks.
Sell it. Sell everything
Indicated
right now.
dangerous
Sell it.
shifts in
The ticker's
institutional
halted.
sentiment
We can't get out.
that
We need more
demanded
collateral
defensive
immediately
positioning.
or we're
The
finished.
psychology proved elegant in its simplicity.
We need to move
Just
this
as
now.
accumulation
Tell the
patterns
men
in
to pick up the
individual
pace
stocks
or they don't
revealed
get paid.
institutional buying, distribution patterns across major indexes exposed institutional selling that would eventually overwhelm even the strongest individual positions. His historical analysis across multiple market cycles validated this integration of macro timing with micro stock selection. During the 1990 recession, early recognition of follow-through day signals allowed aggressive positioning in emerging biotechnology leaders, while distribution day clusters in early 2000 provided crucial warnings before the technology collapse devastated growth stocks. The 1,998 post-crisis recovery, the 2003 bear market bottom, and the 2009 financial crisis recovery all demonstrated how proper market timing transformed individual stock selection from speculation into systematic advantage. The complete framework emerged as an elegant synthesis where fundamental screening through Cannes slim criteria identified potential leaders. Chart psychology revealed optimal entry timing, and market direction analysis confirmed whether institutional conditions supported sustained advances. This integration acknowledged that successful investing required not just finding great companies with strong chart patterns, but understanding when market conditions would allow those stocks to reach their full potential.
This isn't
When
matching the morning
perfect can
figures, we
slim
need to move
candidates
fast.
with beautiful cup
paper
with
says
handle
hold. Look right
formations
here.
appeared during
Why are these
confirmed
climbing?
market
Because
uptrends
someone
signaled
knows
by
something we
follow-through
don't.
days and low
This isn't
distribution
matching the
counts.
morning figures, we need to move
Probability
fast.
shifted dramatically
The
in
paper says
favor of
hold. Look
sustained
right here.
success.
Why are these climbing?
O'Neill's market
Because someone
timing
knows something
methodology
we don't.
provided the crucial psychological context that determined whether individual stock strength represented genuine leadership or merely temporary relative performance during broader institutional selling phases.
Barely worth it sometimes.
His approach recognized that
Let's just get
institutions,
home.
by their very nature,
Who authorized
moved
this
in concert,
exposure?
and
It
their
doesn't
collective
matter now. We have to
actions,
stop the
whether
bleeding.
accumulating after
Sell
market
everything.
lows
I
or
repeat,
distributing
sell
before
everything
tops,
immediately.
created the overarching rhythm that dictated success or failure of even the most meticulously chosen individual investments. This sophisticated understanding transformed his trading from isolated stock picking into comprehensive portfolio strategy that aligned systematic analysis with the grander movements of institutional capital, ensuring that logic and intuition worked in harmony with, rather than against the market's prevailing psychological tides. O'Neill's transformation from individual practitioner to institutional architect became evident in his later years, when he could still be found in the Investor's Business Daily newsroom, pen in hand, marking up charts with the same deliberate attention he had applied as a young Oklahoma broker.
Dropping fast. Get out.
The institution he built transcended traditional financial journalism to become an operating system for disciplined investors, where model books of past market champions sat beside live screens displaying relative strength rankings and accumulation patterns. He had successfully transformed a deeply personal synthesis of logic and intuition into a teachable methodology that democratized access to the same institutional intelligence once reserved for Wall Street's inner circles. The enduring power of his approach lay in revealing timeless psychological truths about institutional behavior that remained constant across technological revolutions, regulatory upheavals, and evolving market structures. Whether analyzing steel companies during the industrial expansion of the 1950 seconds, consumer discretionary leaders throughout the retail revolution of the 1980 seconds, or biotechnology pioneers during the genomics breakthrough of the 1990 seconds. His framework consistently identified the same underlying patterns of institutional accumulation and distribution. The visual language evolved with electronic trading systems and algorithmic execution. But the fundamental psychology of fear, greed, and professional money management continued expressing itself through recognizable chart formations that revealed where smart money was flowing regardless of prevailing market narratives. His intellectual evolution across multiple decades demonstrated remarkable adaptability within disciplined constraints, refining specific applications while never abandoning core insights about investor psychology. During the dot-com fever, he insisted that leadership without earnings must still demonstrate operational momentum through genuine price and volume demand, not merely narrative enthusiasm from speculative buyers. After the 2008 financial crisis, he observed how deeper, wider base formations and more violent shakeout periods could precede exceptionally durable advances, adjusting his expectations for base characteristics while maintaining the same non-negotiable stop-loss disciplines that protected capital during inevitable corrections. The methodology's most profound contribution emerged through its synthesis of systematic analysis with psychological awareness, proving that successful investing required neither pure quantitative approaches that ignored market psychology, nor purely intuitive trading that lacked systematic discipline.
Look at these numbers.
His framework provided practical tools for reading institutional footprints through relative strength lines, making new highs before price breakouts, recognizing authentic accumulation through decisive volume expansion during base formations, and distinguishing between genuine leadership and temporary relative performance during broader institutional selling phases. This integration acknowledged market complexity while offering systematic approaches for navigating that complexity successfully. O'Neill's legacy lived not in specific stock recommendations or market predictions,
We need to move this now.
but in the disciplined routines that transformed uncertainty into repeatable process. The pre-market planning sessions that prioritized leaders approaching proper pivot points. The post-trade reviews that evaluated execution quality rather than immediate outcomes, and the weekly audits of distribution day accumulation that calibrated portfolio exposure all represented habits that compounded investor behavior long before results appeared in account statements. He taught that cutting losses represented not failure but the intelligent purchase of future opportunity, that adding to positions from strength constituted patience disguised as aggression, and that real wealth accumulation occurred through behavioral consistency rather than occasional spectacular trades. The complete philosophy he developed recognized that market mastery wasn't about prediction, but about creating systematic approaches that worked with human psychology rather than fighting against fundamental emotional responses to fear and greed. His methodology served as a bridge between academic theories explaining market efficiency and practical realities that created profitable opportunities for those willing to study institutional behavior patterns with sufficient discipline and patience. Through decades of market cycles, his synthesis of logic and intuition continued. providing reliable frameworks for identifying leadership, reading accumulation patterns, and protecting capital, while allowing profitable positions to develop their full potential within the eternal rhythm of institutional buying and selling that defines successful market participation. O'Neill ultimately left behind not a rigid system of rules, but an adaptable framework where logical discipline narrowed the universe to companies with exceptional fundamentals and favorable supply characteristics, while trained intuition recognized when chart patterns and volume signatures revealed authentic institutional pressure. This ongoing conversation between systematic analysis and psychological awareness empowered individual investors to compete effectively with professional institutions by leveraging the same behavioral insights and pattern recognition that sophisticated money managers relied upon for consistent success, ensuring that his synthesis of logic and intuition would continue guiding disciplined investors through whatever market conditions the future might present.